Hello, everyone, and welcome to my one-to-one sit-down with my guest today, Rory O'Mara. Rory, welcome. Thanks for
Hello,
joining.
Raj. Thanks for the opportunity to have a chat with you for a few minutes.
No problem. Very much looking forward to it. Just a quick intro for you. You are a specialist in property finance. You're the CEO and founder of Closed Bridging Finance, and you've been lending your money to property investors and developers since 2006. I'm very much looking forward to getting an insight into your thoughts into the current state of property finance, the market, and we're going to touch on the current pandemic as well, COVID-19. But before we get into all that, Rory, can you start from the beginning? Can you tell us a little bit about yourself, how you got into property and your journey?
Absolutely, Raj. So, hello, folks. Thanks for taking the time to listen to our podcast. I'm Rory O'Mara, as Raj said, the founder and CEO of Closed Bridging Finance. I set this business up in 2006. A bit of background. I'm based in Winchester, lived here for about 23 years, married to Charlotte. We've been together 33 years. We've got three kids, two dogs. My passions are, Formula One, motorbikes, the trip to Vietnam recently. Really enjoyed that. Put me well and truly out of my comfort zone. And I'm really big into putting people out of their comfort zones because it helps you achieve more. Those who know me, who've worked from me, know that I'm blunt and direct, and I like to challenge people. And the key drivers for me are things very much based around family, integrity, trust, and honesty. And those who work with me understand exactly how that works in my life and how we go about lending money. A little bit more of background, if you're interested. I lived in a whole bunch of kids' homes and stuff in the 80s and the 70s, and then came to the UK in 1980. I had a real passion for not wanting to be poor. It's probably the best way to explain it. And I managed to put myself through university. I got a job in sales, and I got into sales for one reason, because your earning capacity was unlimited. It really was as simple as that. If you're a good salesperson, you've got great skills. So my first job was for a company called NCR. So if you ever get money out of a cash point machine, I worked for one of the teams in the city that sold all the consumables. So for you young people listening, you probably have no idea what I'm talking about when I say I sold floppy disks, fax paper, and telex paper. And that's what we did. And you absolutely got to understand the whole concept of rejection and no. And you need 9 no's until you get a yes. And that's what I learned, which you've got to keep on keeping on. What I learned from that, I moved on, and I always look to follow, not necessarily the crowd, but I look for the opportunity. And the opportunity in the very late 80s, early 90s was technology. So I got involved in technology, which is to do with service desk and help desk. Always wanted to run my own business. Did one, didn't work. Went back, set up another one called CRM Works. I sold that to my business partner in 2005. And then around that time, I thought, right, I need to find something that's new, that's exciting, that's challenging. Where are the trends? And that's really when property started to take off. So I did a little bit of training with a property company. Didn't really understand much about property. But what I always look for is the problem. And that's the key thing. Is there a problem? How can I solve it? And one of the big problems in those days, when it was very easy to do what we call no money down, was that you needed what we called a daylight bridge. And that was when it was possible to buy a house in the morning using some or other people's money, a bridging lender. And so I set up Closed Bridging Finance. And that was very simple. You'd buy a house that was worth 100K, say for 70. We'd lend you the money in the morning, and you already had a remortgage lined up in the afternoon with a lender called Mortgage Express. And then if you hear about people owning hundreds of properties, they use that model. And we became quite well known for providing funds for essentially a daylight bridge or a closed bridge. And then we moved on to do, when that stopped, essentially when the crash happened in 2008. And we went on to lend money not for an hour or a day, but for much longer time periods. We also borrow from investors. We pay them, we lend. We did build a portfolio of property, of HMOs, which we have since sold. I can cover that a bit later. And what we do now is primarily lending and broking of finance. So that's sort of where we are now, Raj. We don't own any property, but we are looking for good deals, which I think will come a little bit later in the year.
No, I appreciate it. That's a great intro, Rory. It tells a lot about you. And I've just got a quick follow up question from that. And you did touch on building a portfolio potentially for a little bit. And the question was why did you start with property lending? Why didn't you look to build your own portfolio or do your own deals from the start? Why lending?
Yeah, sure. So if I'm brutally honest with you, the reason we decided to do this is I have more of a trading mentality. I didn't want to be a landlord. I don't have the skills to look after tenants. And I think it's important to understand where your skills lie. Also, I looked at this as essentially the gold rush. And I didn't at that time want to be the guy looking to pan for gold. I wanted to be the guy who owned the shop that sold the picks and shovels. So I
Yeah.
just thought I'd take a slightly different view. Also, prices were getting a little bit toppy, which is why we thought we'd just step back. And obviously, the crash happened. And if I'm honest as well, we were making way more money lending money than we would do if we held the asset. And I'm not saying either strategy is right or wrong, because we did go and buy property a bit later, but we didn't want to buy it before. If you looked at the charts on price, my view at the time around '07, '06, '07, I thought prices were toppy. And if you recall, interest rates hit a ceiling, I think, of about 4.99. That starts to get, it's just not economical, or it's difficult to get a return on your cash if you're paying those sorts of rates on borrowed money for buy-to-let mortgages. So we decided to back off and carry on doing what we were doing with the bridging.
No, I mean the analogy of the gold rush analogy I think is perfect for that. Stick to what you know, stick to what you're good at, and don't follow the shiny penny syndrome, so to speak. There's other ways to make money, and that's exactly what you've done, which is fantastic from that point of view. I want to
Sure.
move on now and just quickly touch on, for those who don't know, what is bridging finance? What is a bridging loan?
Bridging finance is essentially short-term funding. And I would say that's typically from 1 day to, say, maybe 12 months. It can be longer, but generally you'd use bridging funds to buy a property for a number of reasons. But one of the main reasons would be that property is not mortgageable at that time. So it might be, let's use a 3-bed house. There's no kitchen, no bathroom. You cannot rent that property. You can't put tenants in it. A regular buy-to-let lender won't lend funds. Or they'll agree to, but there'll be a retention, which means that they won't give you the money in the first place. So you'd use a bridging loan to buy it, then to fix it up, then to refinance it, or to resell it. So number one, you'd use bridging on non-mortgageable property. Two, cash, you can move more quickly with cash, as opposed to waiting maybe for if it was mortgageable, but waiting for a buy-to-let lender to provide funds. If you're very quick, and it can be done with indemnity insurance, maybe on the searches, you could probably get a property over the line in maybe 5 to 10 days. That's all down to the lawyers doing their job, which can slow things down from time to time. And the other one is to beat competition. It's about speed. But more often than not, you're buying a property that's not fit to be funded through a traditional mortgage. Separately, obviously, there's development, which we'll come on to.
No,
Um,
that's
so, so,
brilliant.
so that's essentially it's short-term bridging. So it's short-term funding, 1 day to 12 months. Normally, the property may not be mortgageable. In terms of charge, just to understand that, to keep it clear, if I'm the bridging lender, or we're using any other plain vanilla bridging lender, they will take a first charge on that property. So essentially that they own it. Yeah. You can get bridging funding on a second charge basis as well, if the loan to value or the gearing is low with the first charge holder and they provide permission. And the other thing you just want to bear in mind is I'm talking about non-regulated loans at the minute. If we're talking about using your principal private residence, i.e. your main home, it's possible to get to get second charges on that, but it's regulated, and we'd have to use a regulated broker to provide that facility. We are FCA regulated for credit broking, all of our work is essentially non-reg work, which is investment based. In terms of just coming back to the point on bridging, typical loan to value, you'll hear lenders say we do 75% loan to value, 70% loan to value. What you really want to understand as an investor / borrower is what is the net advance on the day of purchase. For example, let's say you're buying a property for 100,000. A typical advance from a bridging lender, depending on the loan term, and you normally want to go for the maximum loan term you can. Do not take a short term of 3 months or 4 months, because if you can't refinance, depending on the terms and conditions of the loan, you may be charged additional fees. You may go into default interest. So what you want to do is to get the maximum term, say maybe 12 months. Normally you will only pay for what you use. So you're not going to have to eat the whole buffet. You're just going to have to pay for what you've eaten. So you get the 12-month term. That will have an impact on the advance. The longer the term, the interest is retained for that term, say 12 months. So you'll probably end up with an advance maybe of 60% or thereabouts. But it's crucial because you're the guy who, as the investor, is going to have to put in the difference. Buy at 100, get 60% net advance, you've now got to find a 40% deposit. That's very different to a buy-to-let mortgage, say, if that was a 75% loan to value, then you'd only have to put 25% in. Yeah. So that's one key thing. Normally, you don't service the loan interest on a bridging loan monthly. You can do. It's unusual. If you're servicing it monthly and the lender is happy, then you'll get a higher loan to value. But you'll have to be able to evidence you that you have the ability to service the loan monthly. But most investors don't particularly want to part with their cash monthly. They'll just pay back at the end. And the guys that I work with, that's how we operate. So we'll agree a term, could be 9 months or 12 months. They'll pay back when they've sold the asset, having refurbished it or refinanced it. And so coming out of the bridge, and this is crucial, you really do want to understand what are your exit routes. So it's easy to get into the bridge, and I just say be careful with whom you speak. I have spoken with investors who've worked with other brokers who said, yeah, I can do that for you. And then you look at the deal and you go, well, how are you going to get out of the deal? What's the exit route? And they don't have that clarity. Normally an exit would be a sale or a refinance. So the rates will depend on loan to value. It's very difficult to turn around and say, oh, this is the rate. Through some loans that we have brokered on really low loan to value, we've got it down to about 0.49%, which is very, very low, but a very low loan to value. And then much higher loan to values. So, for example, some of the projects I funded could be as much as 3% plus per month. But if I'm funding 100% of the project, the buy and the build, then you'll pay for it. So all of those are normally negotiable, depends on the project. So there's a good sort of overview of bridging. Yeah.
No, perfect. I think it's important for people to have a complete overview of it, and you've answered so many micro questions that I had in there, which is perfect. Let's just sort that out. So I'll move on to, you mentioned bridging can be used on properties that are not mortgageable, but what specifically, what type of properties would that be, can be bought with bridging?
I'm trying to think back. If we look at, if it needs work, you'd use a bridging loan so you can add some value. If you can't really add value, why would you use a bridge? I mean, just think about that for a second. So a 3-bed house, it needs some carpet and a lick of paint. Regular buy-to-let lender through the valuation process when the surveyor arrives, they're going to be quite happy with that. So if your plan is to keep the asset, you'd put that on a 75% loan to value. It would be stress test on the rental income. You'll have 25% deposit. Find a property now that's in need of work, and it might be a property that you want to convert into an HMO. Think, oh, I can find a 3-bed house. I understand the rules and regs in relation to setting up an HMO in the area. There is massive demand, so I know I can fulfill the demand. So you might, and we did this with one that we bought. So we had one in Swindon, regular house. It was a little bit tired. This was a few years back now. We paid about 170, I think, off the top of my head. and then 75,000 or thereabouts, again from memory, to convert that into a 6-bed, 6-bath HMO. Then had it revalued. We knew what the value would be prior to entering into the project. My bridging company lent my property company the money. We did the work. We used Lloyd's Bank commercial finance to take out the bridge, so we had a very clear exit, and we left some money in. So in that example, that would be doing a conversion of a regular house into an HMO. I've got another project which is pending right now with a client. Same concept, convert a property that was a bit of mixed use. It was a hairdresser's downstairs and it was their home upstairs. Convert that to an HMO. And most of the projects we've sort of done will be along those lines, or we get into development, which is slightly different. So then you've got whether it's regulated or not regulated. So if it's for investment purposes, that's a non-regulated loan. If you are using your principal private residence on a first charge basis, that is a regulated loan. It's a very different process. You can do it. You can get funding, and you can get a bridging loan. But normally, what you would do is, if you were using your principal private residence as security, you would you do that on a second charge basis. And again, that's another way, a great way of raising capital. Yeah.
Yeah, so I guess in that case, if someone wanted to improve their kitchen or their bathroom in their own residence, if they've got enough equity in their home, they might just take a second charge on top of that.
Yes, I mean, on something, if you use that as an example, maybe a kitchen and a bathroom, what I would probably do, and I've done this myself as a money lender, I've just gone directly to Martin Lewis's website, Money Saving Expert. I've looked at secured and unsecured loans. And we had some work done on our garden years ago. It was way more than I thought the budget would be. It was just crazy. They turn up in the road, you start adding some zeros, and we needed some brickwork doing. And we thought, oh, actually, I think we got the money through Santander, 2.x%, 3%. It was in our account within 24, 48 hours. So it was cheaper for me to borrow than to use my own funds. And that was an unsecured loan. But you can equally do, and we have helped investors raise working capital off the back of the security, so the equity in the main home for business purposes. It is stress test on income, etc. Yeah, but that is possible.
So just quickly moving on then. So, if an investor is looking to use bridging finance to build a portfolio, how would be some of the ways that he might be able to do that, or they might be able to do that?
Okay, so if you go back to some of the points that we've discussed earlier, bridging is essentially, the guys I work with who get this, they understand leverage using other people's money. So you have to understand the journey that you're going to go through. There's the start, you have a clear plan, a clear strategy. So it might be to build a portfolio of single lets, it might be a portfolio of HMOs, or it might be mixed. It might include some commercial as well. So I think the first thing is to understand how much working capital do I need? Can I borrow money from third parties? You could potentially borrow money from private investors. You could come to work with someone like myself where I lend my own money and I borrow, and I will lend where other lenders won't lend, but you will pay for it because there's more risk. So the first thing is to understand the concept of leverage. What do you need? If you haven't got it, is it worth paying for the money? And I think it always works on the basis that you're using bridging where you're adding value. So I've got a live case. I've got a particular client. I think we've done 40 or 50 projects now, loads, in the last 10, 11 years. So we're just waiting for funds to come back on one project. Another project's ready to go. We've done all the legals. It's the conversion of a property into a 6-bed, maybe a 7-bed HMO. I'm not sure if we'll do the 7 now because of the COVID issues, and also you need planning consent because it's 7-bed. It would be sui generis. This is it's not an outrageous buy price, about 112,000. He's got his own team that will do the work. It'll probably cost him 65,000. The rent roll in that area will more than cover the debt once he refinances. And I can't remember the exact numbers off the top of my head, but he will leave a very small amount of money in that project. And so then the figure would be, it's worth paying for the bridging. You leave some money in. So I'm making this up because I just don't have the figures to hand. But let's say he left maybe 10, 15, 20,000 in the project. So then you would just look at that, say the 20,000. What is the profit that he will achieve having covered all his costs? And what is that as a percentage of the capital left in to work out your return on capital employed? Now, I've always worked on a return on capital employed of at least 10%. So if you're getting a ROCE of at least 10%, that's a great deal. And he just rinse and repeats that time and time again. So we've got that project, we've got another project to do, which is a longer term, it's a 12-month planning game. I'm prepared to fund the purchase of that asset for at least 12 months whilst he gets planning. He will get planning. You just have to be prepared to play the game, the planning game. And then obviously once we get planning, I'll move out of that. We'll bring another lender in that would be cheaper, and then he'll convert that from memory. I think it's 22 flats. So that's an example of where you'd use someone else's money. So you're not tying up all of your own capital. And the guys I've worked with who are really successful, one in particular, I remember we had a lunch at Christmas about 4 years ago. I said, just how many live projects have you got on the go today? 24.
Wow.
Yeah. So I knew it was high.
That's a pipeline. Yeah.
That's a pipeline.
Yeah.
And that's exactly what it is. So if you're familiar with Grant Cardone, that guy talks all about 10x. Well, that's how you 10x your business. You look at in the pipeline, he's constantly looking for deals. He's built a team, and he just started with nice 3-bed houses as single lets. Then when I started working, we did loads of HMOs. And then we did a conversion of a property to a 48-bed student HMO. Since gone on, done a 200 or 300-bed HMO, student block, and others. And that's all about using other people's money and understanding the power of leverage and understanding the risk.
When you're talking about the amount of deals that particular client was doing, it's important for people to understand that they're not all going to finish at the same time. They're staggered. Sometimes if you're waiting for planning or delays on site, it can completely change. So he's de-risked by the fact that the timeline's all spread out as well at the end of the day, isn't he?
He is. And to be fair, and I have other clients who do similar things. They might buy 3 deals where you've always got to add value. It's rare that you buy something that's ready to run. You would sell that to what I might call like a retail investor. But as a property investor, a trade investor, you'll find something, you'll add the value, you'll sell it on. And if you do 3, you might sell 2, keep 1, or sell 1, keep 2. So because you need the cash, you need some of your own cash as well.
Yeah, perfect. And we're kind of moving on to a little bit of, when you're talking about enhancing a site or improving it and adding value, we're talking a little bit about development there. So can you explain for people listening what the difference is between bridging finance and development finance?
Absolutely. So let's start with, I've talked about bridging. So keeping it simple, you're buying a property that essentially will need some work. You want to enhance its value. It's not mortgageable. If we use our example of 100K, which we did earlier, the gross loan to value may be 70, 75%. The net advance may be 60%. The funds are advanced at the start for the purchase. That's the bridge. Now with development finance, it's very different. So with development funding, we will look at either major refurbs, not necessarily ground up new build, because I can probably borrow that money elsewhere cheaper where we broker it. But a lender will look at what the concept of what's the GDV, what's the gross development value, and they'll fund based on that GDV. And that could be anywhere between maybe 50 and 60% of the gross development value, i.e. the end value. And how the funding works for that, Raj, you look at the GDV and you'll say, okay, we'll give, for easy math, say 50% of the GDV, because it's just easier. If the GDV is 1 million, then the funding line for that will be 50% of 1 million, which will be 500,000. The funding is then split into two parts. One is how much money will go towards the purchase and how much money will go towards the build. And it will normally be 100% of the development cost funded in stages and in arrears after the work has been inspected, certified by the surveyor, and then signed off. And that money is normally transferred within 24 to 48 hours. So you get 100% of the build, and normally about 50% or thereabouts of the purchase price. Now that depends what the GDV is, but the first thing is the lender wants to lend on the build. They want to see the borrower have skin in the game. So, okay, Mr. Borrower, you've got to put 50% in, at least, ideally, of the buy price. We'll put 50% in, and then we'll do 100% of the build, providing it does not exceed more than the GDV. Now, I've got a private fund that I work with. That's the model that we work to. Also, you need to understand the borrower's track record, what's their experience, what have they done, who's their team. You have to have planning in place. Very, very rare you'd get development finance on something that's speculative in the hope that you might get planning. Now, I'll lend, as I said earlier, I've got a project that's ready to go. They're just sorting the legals, which is to buy the site, but it'll take a year to get planning. That's not development funding, that's just the pure bridge. Whereas on the development, you need to be ready to go. And yeah, that works really well. Sometimes you might be able to get the main tranche of development funding and to get some mezz money, which is the mezzanine money that sits on top. And I have done that in the past as well. I'm personally not a big fan of being second in line to get fed. I want to be first, but I will look at projects, and it depends how the numbers work out. But that's essentially how development funding works compared to, say, bridging.
No, that's perfect. Cheers for that, Rory. That really helps people listening. If they're new to property investing or development and they're trying to distinguish between the two, when might be a good time to use either or? And touching back on bridging finance, what you said is, look, it's not the cheapest sometimes, but if you didn't use it, you'd have to say goodbye to the deal. So do you want to let go of the deal? Do you want to not be involved in the project? If you had another way, you probably would use it, but it can be a great vehicle to speed things up, like you've said already, like you've touched on.
Yes, absolutely. I think you have to look at the project and work out, okay, can I do more than, if you've got your own funds and the money and you have no other projects, you'd use your own money. Why would you borrow money unless it's incredibly cheap? Or you have a pipeline that you can see another project come down the road. But if you're spending, say, half a dozen projects at any one time, then it makes perfect sense to use leveraged money, maybe perhaps money borrowed from private investors. You've got to do that legally in the correct way, and they've got to understand the risk, and bridging money. And therefore, you can do 2 or 3 deals. Now, as I said earlier, the guys who I work with, they get this. They absolutely understand the concept of leverage. Because if you can do 10, 15, 20 projects and you can manage them, you've got to have the right team in place. It's a bit like Costco or a retailer. They work on phenomenal volume, low margin. But guess what? They make bucket loads of cash because they get the volume through the door. And that's what a lot of the really switched on investors get. They understand that also if they're retaining the asset over time, generally the value will increase, and that's the upside.
Yeah, absolutely. And like you said, understand and leverage the fact that you could buy one house for 100k, or you could buy 4, putting down 25% on each of them, and it still de-risks it for the lender as well. 25%, they're only lending a max of 75%. It kind of makes sense, like you said. The guys who know what they're doing, they'll do it every day. It's a no-brainer.
Absolutely. Sure. Yep, definitely.
So I'm going to move on now, and let's address the elephant in the room. Let's move on to the pandemic, COVID-19. I want to know your thoughts on how you think this is impacting the economy, or will impact the economy, and maybe focus on some of the risks, but also the opportunities as well.
Okay, this is an interesting one. And I think everybody has an opinion. No one really knows the answer. So I've always looked at risk. That's the first thing, risk and opportunity. So let's just look at some of the risks and how you can try and mitigate risk. So as a landlord, you've got lots of different types of risk with your tenants, depending on what type of tenants they are. So for example, right now we're in lockdown, so I don't believe you could add new tenants to spare rooms in HMOs. That's a risk. Excuse me. As an HMO operator, do you have tenants who are students? I know of some landlords, their students have all gone home to mummy and daddy and they're not paying their rent. Now, if you had an entire portfolio made up of student HMO lets, that could be a massive risk. The same for some single lets, depends on the tenant type. If you're a key worker, you're still getting paid, you work in the NHS, a business my daughter works in, they're in insurance, life insurance, nothing has changed in their business. It's full speed ahead. People are still buying life insurance. Whereas unfortunately in other businesses, maybe you worked in a food outlet, like a Wagamama's or a Nando's, say. You're furloughed or you may even have been let go. So there's a risk for a landlord in terms of what type of accommodation you're offering. HMO, single let, serviced accommodation. Some serviced accommodation operators are doing really well. I think they've set up contracts with NHS/key workers, and others are really struggling. For developers, I've got a developer project client of mine. We're trying to get a deal funded. The lender is lending on the live deals where they've already started work, but they won't let them take drawdown money on new deals. They won't look at new deals right now. It's frozen. If you have more of a trading mentality and you flip property, that's almost impossible. It's doable, but it's not easy. And if you're a rent-to-rent operator, I love the rent-to-rent model, but in this environment, you can have tenants not pay you, and you've got landlords you still have a contractual obligation to pay, which could be challengeable. So the first thing is to get the rents in, and you've got to work with your tenants. And I think the NLA have done some work on this, and that really is explaining to tenants the sorts of schemes that are available to offer them some help. I have a client who's also a friend. He has about 100 properties. About 30% of that rent roll is not coming in now. That was for last month, and I need to speak to him. Actually, we'll have a chat tomorrow to find out where he is with this month. It's probably more like 40% of rent. A mixture is residential and some commercial. So the bank said to him, you need to go back and speak to every tenant and get proof of what type of work they're in, who's their employer, have you got evidence that they've been furloughed? And then we will work with you. Now, that was a conversation that he had with the bank about 5 weeks ago. The bank, they were not prepared to be relaxed in any way. They have since, as the investor, the bank has then said, we're quite happy to switch that commercial loan, which is capital and interest, to interest only. So that saved him a lot of money. He's got some cash. He can service his loan interest. The other thing to do is, so essentially we're talking about getting the banks to relax terms or to apply for, there's a whole suite of initiatives that you can apply for. So there's the CBIL loans for businesses, or the easier one that I know property investors have already applied for, which started this past Monday, the 100% guarantee bounce back loan, which runs for a 6-year term. The first 12 months are interest free, and the rate's 2.5%. And you can get up to 50K, but no more than 25% of turnover. So I know investors who have applied and have had success, and they've turned those around quite quickly. There is another one which I've heard about the other day, which is the self-employed income support scheme. So if you're self-employed, you can get a grant, which is not a loan, which is 80% of your average trading profits to a maximum of about 7,500, which is equal to about 3 months' profit. So there are schemes out there. I think the government have done the best they can in this environment. If you're a developer, you've got to work with your lender if you're expecting drawdown. But new deals being funded today on development, I think is tricky. Now, here's the other point. I think we will probably see a recession, which, to be crystal clear, is 2 negative quarters of negative growth based on GDP. And I think, looking at the financial news, that's probably going to happen. The one I'm not so sure about, and I do hope and pray it doesn't happen, is do we move into a depression? And that would take us back to what happened in 1929, 1930, when we had the stock market crash. The charts do look very similar. If you look at the Dow Jones industrial average chart for 1929, 30, and today, they almost mirror themselves. And what you see is you have an initial drop, you have a pullback where things rise, which is where we are now, and then a significant drop back. And it took about 22 years for the Dow to get back to where it was in 1929. Now, again, I hope that doesn't happen, but a depression basically comes about as a result of sustained long-term downturn in economic activity in one or more countries or economies. That could happen. And it's characterized by length. So it falls in employment, availability of credit, and you have a shrinking of output as essentially buyers dry up and production falls. You get more bankruptcies. You also get bankruptcies including sovereign debt, or sovereign debt default. Massive currency fluctuations. You get price deflation and a stock market crash and bank failures. And that's what happened in the 30s. Could that happen today? I have no idea. But I would be mindful that that could happen. And one of the things that we have done, and I would suggest all investors to do, would be the points I've just talked about. But if you're sat on cash in your business accounts or in your personal accounts, make sure that you understand the rules regarding the Financial Services Compensation Scheme. So the FCSC, Financial Services Compensation Scheme. And that's where you are covered for up to £85,000 per person in your own personal bank account, or £170,000 in a joint account. If you had more money in that personal account and that bank went under, you would lose the difference. So it might be worth looking at other bank accounts which are not connected to the same entity, to the same bank, and spread your funds around. That might be prudent. The same for business. You're covered by up to 85,000 total in your business account. So let's say you had 185,000 in your account. Well, if a bank went under, you'd get cover for the 85, but not the 100. So is it worth looking at additional business bank accounts? I don't believe a bank will crash, but I believe in looking at the risk and then looking to mitigate that risk, Raj.
I think that's really important, Rory. Just sorry to interrupt there. You've got so many ideas just thrown around in my head, and the fact that you touched on, I think a lot of people are very unaware that you're only covered in your bank account for X amount. You know, people think it's in the bank account, it's the safest place for it, and it probably is, and it usually is, but it's not completely covered. If something really, really wrong happened, and it shouldn't happen, hopefully, like you said, if we could survive 2008, and that was a financial crisis, we should be able to, deal with most things. I mean, if you think about 2008, too big to fail, it should have failed, right? It got bailed out, it should have failed.
Yeah.
We'd like to think that any time right now is too big to fail, and that you can see the governments, what they're doing, trying to prop the economies up and keep them moving, which is fantastic. But I think it's so important, as you said, to touch on your money is above a certain level, above 85,000 in a particular account is not entirely covered.
No, absolutely, Raj. It's a simple thing. I had this conversation with an investor about 5-6 weeks ago, and we just said, look, let's look at risk. Where is our risk in our businesses? That was one area of risk. Big companies have separate treasury departments. They manage this. I rang around a few friends of mine who run really big businesses. One's quote a company, and said, how do you deal with this? For them, they have treasury departments. They work with big banks where they've got borrowed debt and they offset their debt against their credit. But for the average person like you or I, and your money's in ABC Bank, then one, understand where the risk is. Two, if you also, just referring back to Martin Lewis's website, Money Saving Expert, they do have a link on that site where you put in your bank, say Lloyd's or NatWest, and it will tell you if there are any other connected banks because you're only protected once. So you just want to make sure that you've spread your funds around so that you don't have that risk. It may never happen. But then if you said to me 5 months ago, Rory, give me odds on the Premier League probably not happening, we'll be in a lockdown because of a pandemic, and you'll have people queuing outside Tesco and Adult and Aldi and Waitrose or wherever, I'd probably give you 1,000 to 1 because you didn't think it would happen. So I always do try and think about the things that couldn't happen as if they could and go, right, how can I protect myself? But the other thing is, so that's managing part of risk. In terms of opportunity, because I don't want to turn this into something that's negative, it's just you need to be aware of what's going on. Yeah, I wouldn't buy shares right now. I think there's probably a bit more of a dip. We need to see Q2 results come in for publicly quoted companies. Unless, of course, if you're prepared to take like a 5 and a 10-year view on some stocks, and I was looking recently at Aston Martin. Aston Martin floated at £4.88 a share. They're a 50p share right now. If you follow Formula One, Lance Stroll's dad, who's now the chairman of Aston Martin, bought in a big chunk of stock, which I since think they've renegotiated. Do I see Aston Martin as a stock going bust? It might do. I've no idea. But it's a fraction of what it was when it floated not that long ago. It's got a very strong brand. It's the sort of asset you could see another car company potentially buy. And I look at things like that. And if you can take that very long-term view, which is something we're doing with our SIP and our SAS, with our SIP and our ISA, is, okay, I think there'll be better value stocks to look at. This is not property related. Probably a little bit later in the year. You'd be a brave soul today. So that's something that's slightly separate. The other thing is, in terms of property today, right now I would say, and having spoken to some investors that I work with, they've been speaking to surveyors. The market's sort of frozen right now. Would I go and buy a property today? There had to be a compelling reason. There would have to be significant difference on price point from when it was valued pre-COVID to today. They could boom tomorrow. I could be wrong, but I prefer it to be a little bit more cautious. I have got one investor I work with. He is making silly offers, and I mean really silly offers. Because if people start running out of cash, and I hope they don't, but people don't carry a lot of cash, you'll start to see, watches will get sold, cars will get sold. There's a whole different conversation there just about cars under PCP. I think something like 937,000 vehicles in the UK are acquired under PCP contracts, and 83% of all new cars are PCP. If you're struggling to pay your utility bills and your mortgage and feed your kids, that car payment, that car's going back. So I think there could be an issue in the next 3 to 6 months where there could be a lot of tin going back to auction houses, and will there be enough buyers? The flip side to be is they're not building new cars right now, so you may not be able to get a new car. So there's an opportunity there. But coming back to property, I think right now I've got some guys that are just sitting tight, sitting on their cash, waiting for the opportunity, and they feel that they may be able to pick up the right project at the right time, at the right price, maybe a little bit later in the year. Then I've got others who are actually still buying.
No, and that's it. I mean, turbulent times always create motivated buyers and motivated sellers if you've got cash or access to cash. And like you said, there's people on both sides of the fence. There's no one knows exactly what's going to happen. Like you said earlier, we're effectively on pause. And as soon as we open up, or when we open up, will there be a bounce? Probably likely. But I don't know. But that's my thought. The economy has stopped. The economies have stopped because they've had to, because they've told to stay in. Another thought, actually, which I think was very good that you brought up, and that is almost defining what a recession and depression was, because people hear those words and they're, straight away they're extremely negative words, but they don't understand that it's 2 consecutive quarterly downturns is a recession. And if you think about when the lockdown happened, it's the end of one quarter and the start of another. So even though it could be classed as a recession, I'm just playing devil's advocate. Well, that's to be expected because that's when we stopped.
Yeah.
Let's say.
Yes.
But it's one of these conversations. I mean, I'm sure we could go on for hours. I know I could. So let's move on. And coming out of lockdown, whenever that might be, now, what does the future of finance and lending look like, and bridging finance? What are your thoughts on that?
Yeah, this is an interesting one, and it's a little bit of crystal ball gazing, Raj, because so let's look at some of the things that have happened. Almost immediately when lockdown started, the buy-to-let lenders withdrew. I think it was all mortgage products. About 47% of those products were removed straight away. It's like, wow, that's a word that is overused at the minute. It's unprecedented, but that was unprecedented in such a short space of time. Now, that was about 2 or 3 weeks ago or thereabouts. Many of those lenders have now come back with revised product offerings. Some have lowered their loan to values. So, for example, just this morning, so Kent Reliance have come back to the market. So they have, let's have a look, available up to 70% loan to value. Now, they used to do 80 and 85% on some of their HMO products. I think 85% for an experienced landlord. Maximum loan size, 525k. The property has got to be valued between 75 and 750,000. No foul fees or admin fees, and the funding is available for both purchases and remortgages. So they sort of capped out there at around 70% loan to value. And I think what you're seeing is lenders will lend, they'll lower the LTV, but the challenge today is you can't get a surveyor out. If you're buying a regular house and someone's in it, they will not let a valuer into the property. So a lot of the lenders are now looking at automated valuation methods / desktop valuation. And that's where you'd end up to cover themselves in case there were a dip. Some of those loan to values have dropped. So that's sort of where we are there. With regards to development finance, I think there's two bits to this. If you're mid-development, and I was speaking with an investor last night about this, he said, look, Rory, we've got two things on the go. We've got stuff that's live. The lender is still doing the drawdowns. They've got people on site. They're adhering to the rules and regs. The inspections are being done. The money's being drawn down. But that same lender will not look at any new loans today. They said once lockdown finishes, then we'll come back. Now, how you define lockdown finishing, because if it's a phased approach, it could take some time. So again, different lenders may take a different view. I am also aware that one peer-to-peer lender, or another one, sorry, they've frozen their applications until after lockdown. And then another peer-to-peer lender, which I saw in the financial press yesterday, I think it's RateSetter, they've dropped their loan interest payments by 50% to the investors who provide their funds. So they were paying 4%, they've dropped it to 2%. And they are expecting some potential issues with repayment by borrowers. So there could be an issue in that market. With regards to bridging, what we have seen is lower loan to value. So that's an easier way to say, look, we're still lending, but our LTVs have dropped. And so if it was a 70, 75%, it's now down to maybe a 65 or a 60. That's the gross loan, by the way. That's not the net advance. So if you go back to my old model, say maybe 75 or 70% gross, the net was 60. Well, if your new gross is 60, 65, your net will probably be like 50, 52 or thereabouts. So you've got to bring nearly 48% of the buy price to the table as an investor. That's a big chunk of your own working capital. The rates are always competitive. Money is cheap. Just look at bond rates. Look at good quality bonds. German bonds are negative. Just think about that for the minute. So if you don't want to lose capital, and this is where you have to understand is if you've got money in equities, in stocks and shares, you potentially could lose it all. Put it in a German bond. I can't remember which bond this is. It's the 10 or the 30. I think it's the 10-year bond. It's minus. So it costs you money to give your funds to the German government. But let's say it costs you 0.01%. Well, you'd much prefer to do that as a fund manager than lose 10 or 15% of your working capital or the funds under management. So I see rates being low for the foreseeable future. But normally, what you have is as equities drop, more people will move over to bonds. It's interesting and that's why I like to look at the financial news in the background, just have it on during the day, see what's going on in the States. So I think where we are now is lenders are jockeying for position. No one really knows. What we have to be fearful of is the supply of credit. If that dries up, that will cause a problem. And the reason we've been able to buy property, do all the things we've wanted since the crash, there's been no shortfall in the availability of credit. It's not been that difficult to get a loan from a bank, and the rates are crazy low. Get a mortgage on your principal private residence for 2% or less.
Lending is very much, there's plenty of funds out there, and lending is happening, and it seems like you've said that it's a case of keeping your ear to the ground, because this stuff, the way this is moving, things can change and alter daily, weekly. Different lenders will do different things as countries come out of lockdown, but no one knows exactly what they're going to do. One thing's for sure, they have to keep lending at some point. They have to make money, you would think. But like you said, keeping your ear to the ground right now is probably the best thing, and keeping an eye on what's out there, what products are out there, and what banks and lenders are doing.
So just to give you a quick example, I attended a property meeting just before lockdown. It was a local auctioneer came in to just talk about the market. And obviously he said in the previous 18 months, a lot of his really switched on buyers, where people weren't really buying, because you had all the Brexit stuff, which seems like a long distant past, the concept of all the Brexit talks. He said, on the whole, people were not buying aggressively. But he said, I've got two or three, they're big buyers, they buy everything. They basically hoovered up all the stock that was available. And so we said, so where are you now? He said, well, this was before COVID. He said, now they're backing off because they expect prices to increase. And then the retail buyer, retail landlord, so to speak, come back into the market, not buy aggressively as they were buying. And he said, so we're expecting our auctions to boom. Then COVID happened. So now, if you've got cash, and look, if you could buy at 50p in the pound, you'd probably buy. But would you buy at full price today? And I spoke, funny enough, I had a Zoom call with an investor yesterday, and he said, look, I had an opportunity to buy a property, 3-bed house for 250. I would have bought it all day long. Today, I said, if it was me, I would probably want to see 10% come off that. He said, that's exactly, he said, I'm in no hurry to buy. But another landlord might say, you know what, look, I'll pay 250. I'm taking a 10, 15, 20-year view. Different people have different appetites for risk.
Yeah, and they see different things. Like you said, some person will not pull the trigger on a deal because they're looking for a percentage off, a 10% drop in it. Someone else might see, actually, I see a way of adding 10% to this property that person's not looking at. So like you said, there's winners and losers everywhere. There's different risk appetites, and watch this space. Time will tell who ends up on top and who may. I'd love to hear, it'd be interesting to hear who was able to do some buying during this time and how things went. Maybe after this we'll be able to find someone and get their thoughts on it.
Well, I know there is, I won't name names, but I was following on social media. There's someone in your neck of the woods who also runs an estate agency. And I did see he posted he bought 13 properties or sold 13 properties in the last 30, 40 days.
Wow.
Which wouldn't surprise me. If you can gain access, it depends how you're buying. And if you can get a surveyor in. I think it's tricky to get surveyors in, but they will go in if it's empty. Then that's an easier transaction to do. So I don't doubt that there are people buying for sure, and we might come out of this and actually people look back and go, if only. It's back to appetite for risk, isn't it?
That's it, and people were probably saying that about 2008. I mean, the amount of millionaires that were created back then, but like you said, appetite to risk. When you're going through the storm at the time, it's hard to see those opportunities sometimes, isn't it?
Well, I do recall, Raj, it's a story tell the kids. So when I worked in the city, I sold a financial news service called Examiner, and it was a box, a TV screen that we installed into dealing rooms. So not a feed of data, a physical TV screen with green characters. And I remember watching one day because I had this box. So we did real time news. We had our own journalists. They would précis the news when regulatory news was issued in the morning. And there was a company called Next, the clothing store. And Next shares went from 20p down to 7p. And I watched this and I thought, now that is a brand that can't go under. Next was spun out of another entity, and I just can't quite remember what it was called. And I thought, but that's a brand. I can see that that's got value. So I bought 500 quid's worth of Next shares for 7 pence. I think 3 weeks later, they went up to 21p. I sold. I made my money. Next went on to rise to something like, I think it was 35 or 45 pounds per share. All I had to do was sit there with my 7p per share, 500 quid's worth, and leave it. And we worked it out with the kids the other day. I think I would have made something like 250, 265,000, depending if it was 35 pounds or 45 pounds a share. So if you're young and you can, and time is on your side, on the whole, you generally won't go too far wrong, which is why I love reading stuff about Warren Buffett. That's how he made his money in the late 70s. Late 60s, early 70s when there was the crash. He acquired lots of cash. He sat there and waited, and then he bought top quality stock, cents on the dollar, and then sat on it for time. And also, it was interesting last week when Berkshire Hathaway had their annual AGM, which you normally get about 40,000 people turn up for. They did that as a broadcast, and he announced that I think they offloaded stock. I think they had shares in 4 airlines, and no emotion to it. Offloaded, I think it was 6 or 7 billion, and took a massive hit. Could not see any value. Now that's something that when I say it concerns me, because it wasn't that long ago he bought into them, but he thinks right now, for the next 3 years, doesn't see value there. So as an investor, are you a trader? Are you in and out? Or are you in it long term? If you're in it long term, this will be a blip. If you remember the crash of 87, when all the trees came down, people thought it was the end of the world. But if you look at the stock market chart for that period of time now, go back, it's a blip. So it's all about perspective, appetite for risk, and how long can you invest for?
Let's move on to some of the property strategies that you think have long-term potential. Where do you think some of the opportunities are in property investing?
Yeah, so I think this comes back to, you don't have to have studied economics, but you do need to understand this. Number one, supply and demand. If there is lack of supply and massive demand, the price will go up. So the first thing is, you have to provide, as an investor, property investor, as a landlord, accommodation that meets the need of your customers. And so that might be 3-bed single-let houses to families, or it might be flats, or it might be self-contained units, which will be slightly smaller, say, than a flat, like a bedsit, etc. So you need to understand your market. You need to understand that there's massive demand all day long. And if you understand that, then you know that you'll be able to rent. Now, for example, you might say, I want to build a portfolio of HMOs. But if you are entirely focused only on student HMO, where's the risk? Well, my view would have been, the risk historically would have been, what if the local, the uni goes and builds its own accommodation? That could be a potential challenge for an investor. What I didn't think of is what would happen in the event of COVID, and the students would all go home and ask not to pay their rent, which you think, that's unusual. So I think simple, safe stuff today would be, for example, can you work with the local authority? Can you work with the local housing association? What do they need all day long? Maybe there's a niche play where it may be vulnerable people, maybe vulnerable women, vulnerable youngsters. Do they have a shortage of that type of accommodation? That's the sort of thing that I would be looking at as an opportunity. So it's just understanding what does the market need? Can I deliver what the market needs? Do I understand the flow of money? Do my tenants have jobs? If they were made unemployed or if they were furloughed, that's a word we never heard of 6 weeks ago. Yeah. So it's just understanding your market, and those are the sorts of things that I would be looking at. I also think there may be some landlords who go, you know what, I just want out. If you're a novice landlord, it's not really your cup of tea. You've probably got a full-time job, 2 or 3 units. You might just think, look, I want out. That's an opportunity to snap up some stock. Serviced accommodation. Now that's an interesting one. It's not a model I understand, but you are competing with hotels. So it depends on your customer base. You could really be struggling if you're just looking for people who want to go and stay in accommodation in London or wherever it might be. But you may be able to have a contract with a local authority, and you can pivot your customer base to something else. So again, that could be risk. Rent to rent. Again, I thought it was a fair strategy. It's a strategy you follow if you don't have funds. But right now, again, it's back to demand. You need to be able to find customers who can pay their rent all day long, because you have an obligation to pay the landlord. And again, it's just understanding what your customer needs.
Yeah, it's interesting on service accommodation. Actually, I was thinking that one of the advantages potentially coming out of lockdown is, are you going to go into a hotel that has a big lobby, restaurants and all this in there, 100 odd guests, or are you going to stay in a cottage sometimes if you've got that unit to rent, a cottage with your family that's only 4 of you and you know it's private, you can get a deep clean afterwards and before and things like that. So there's opportunities there in this transition, isn't there, potentially?
There is. And actually, that's a really good example. And actually, what I would think is, if you said, so we've got a flight booked to go, my brother lives in California, to go there in August. I think it's highly unlikely we'll be on that plane. I'm not sure if the plane will run. And actually, I don't know if I'd want to take the risk of being on the plane. Charlotte was more worried about actually if there was another lockdown. So you get a wave 2 of this and then being stuck in the States and she couldn't get home. So I think there will be a big demand for holiday accommodation, potentially in the summer, where people won't go away. So actually there's that. And also, do you want to go and stay in a hotel versus actually could I stay in a serviced flat? You'd probably give the hotel a miss. So yes, again, I think it's all about doing your research and having like an avatar for your customer. So know who your customer is, so that you can go and target that particular customer and allay for now whatever their fears may be. Yeah.
Yeah, like you said, you have to do your research, and in that case, it's potentially, like you said, scratching your own itch. Okay, if I was going away, if I was going on a holiday, where would I go? Chances are, if I'm thinking it, you've got some other people hopefully thinking about it. It's quite a logical thing. I'm the same as you. I think just before the lockdown, I was meant to go on holiday away, and we weren't able to go away. And then our thoughts started going towards, okay, can we go somewhere in the UK? Can we just go to Cornwall? Can we go to the Cotswolds? Yeah. But obviously lockdown happened and that got changed as well. Moving on again. So if a high net worth individual is looking to take advantage of the opportunities that might be coming up on the horizon, how would they get into short-term lending? How could they get into that?
Yeah, I've had lots of people over the years ask me how to do this. And my initial thoughts are, you want me to tell you how it's taken me 15 years or so to set up a bridging company? Do your own research. It's not easy. I do meet people think, well, it can't be that difficult. You lend cash. So if you wanted to get involved in this, there are a number of routes. Yes, you could set up your own bridging company. It is risky. I'll be very clear about that. There's absolute risk involved. You've got to have all the right people in place in terms of valuers, solicitors, understanding how to underwrite. Are you doing bridging or development funding? If you're releasing funds in stages, you need to have a QS who's going to act on your behalf. So yes, it is doable. Probably the easier route for most people, Raj, would be actually use some form of crowdfunding facility like a P2P type lender, where you can lend either debt or equity. So you either have a stake in the deal or actually it's a loan. I think that could work for lots of people. You'd have to do your DD, your due diligence, understand what you're getting into. As I said a little bit earlier, I think one of the peer-to-peer lenders has said, look, they're going to drop their interest payable to the investors by 50%, from 4 to 2%. I think, wow. So personally, I don't do that. I like to be in control of my own deals. It's taken me years to understand this. There is potential fraud. You could lose a lot of money. We work with the investors who've got spare cash. So this is another way where we borrow from Fred. We'll agree a rate with Fred, and I've done this for many years with clients. And we work on what I call a matched deal basis, i.e., I only borrow money if I've got a deal that's ready, baked, good to go. So what I don't want with, I think, some of the peer-to-peer lenders, they'll take your money in and I'm just trying to think of, there's a company on the South Coast. Go Google it, guys. They're in administration called Lendy, Lendy. I don't have all of the facts. I wasn't aware of them, but Lendy took a lot of money from investors and they lent it. Well, it didn't quite work out. So why do things not work out? Well, if you've got lots of money, I guess, that have come in, you've got to get it out the door. So are you as strict in your lending process, or are you just getting the money out the door? Are you, is the borrower, are they servicing that debt monthly, or what's happening at the end of the loan term? And I think Lendy, if you do the research, you can start to see a bit of a picture. But I believe there was 150, 170 million plus, I believe. You need to check the exact facts. So we only borrow and do a live deal. Then the money comes back from the investor. We pay our investors. So that way we're not holding on to people's cash, and definitely we don't want to do it. We do it literally with a handful of people. The other thing is we only ever lend on a first charge basis. So you could get into this. So basically do it through a platform which is all regulated, nice and easy. Or you could look to go potentially joint venture. Got to be very careful here because there are a whole bunch of rules based around working with sophisticated and high net worth investors. And again, you'd have to do that research, or people can have a private chat with me where you can work on a profit share basis, but only if you're high net worth or sophisticated, or you could do a loan note. Again, but you can't have multiple loan notes because that could be a collective investment. So there is complexity in it.
That's it.
The other way would be
not as simple as people think, is it? Like from that perspective, people just think, "Oh, I'll just take my money and give it to Joe Soap or whatever." But like you said, there's ways to do it. There's ways to dip your toes in and learn as you go along. And like you said, can you invest with other people who know what they're doing? That is one way. But do your due diligence, as you said.
Absolutely, definitely, yeah.
Rory, we've got just the last few questions now.
Yeah, sure.
Move on to a slightly different section. I want to talk about some of the lessons you may have learned from the past. Any mistakes you might have made. We all have, but they've really helped you in today. As you've grown, as you've developed. So, any lessons that investors can learn from you?
Every day is a learning day, Raj. That's what I've learned.
I'll write that down.
Every day is a learning. I think I took that from Tony Robbins' course I did when he first ever came to the UK, I think in 93 or thereabouts. And it was every day is a learning day. So what do I mean by that? I don't profess to have all the answers, definitely not. I do a lot of one-to-one strategy reviews with investors. I think we even did one some years back. So
we did, yes.
First thing is, you need to have a really clear plan and review that plan regularly. And if you haven't got a plan, that's where you can start to make mistakes. You've got to do your due diligence. Now, I know you'll hear this. People say, well, what do you mean? You've got to understand where all the risk lies. Where we went wrong in the very early days, we worked with one brokerage and it gave us all of our business for our no money down deals. So we put all our eggs in one basket, which was fateful. Because then we found out, I was at an event, I won't name the names, but I was at a charity event bidding to drive in a tank with the guy who owned the brokerage. And I got a tap on my shoulder and someone said, you do know he's just set up a bridging company to compete with you. I went, I didn't know that. He went, yeah, you guys are making too much money. And anyway, cut to the chase, we found out that they did set up a bridging company and they saw that we were making too much money and they didn't like it. And we went, wow, we just put all our business through that one entity. So spread your risk. Don't just rely on one customer. The other thing is understand the market needs. Now, I know I've raised that a number of times, but this is absolutely key. You must understand the demand. If you're a landlord and if there's oversupply, you will struggle to rent your rooms. So I remember I was a big fan of HMO around 07, 08. Did a lot of work around it, funded lots of them. And there were very few lenders mainstream lenders who funded HMOs. They've all got those products now. But I remember speaking to some of the MDs of those firms years ago, had lunches with them, go, why don't you create an HMO product? And they're all on that bandwagon now. I think it's probably a little bit overcooked, if I'm honest, because there's a massive oversupply of HMO in some areas. So you need to understand what the demand is. The other thing is you've got to understand the rules and regs. So what are the rules around planning? You need a really good, your team members, the go-to person for the first thing you do. Who's your planning consultant? Because before you waste any money doing anything, what is their view on, can we get planning consent for this particular piece of property? And they're worth having, they're the first person. So rules, regs, all that stuff, you need someone who can help answer those questions. You need to have a really good solicitor that you work with so that they can respond quickly. And the other thing is working with an agent. So here's something that is just completely off the wall. Imagine you have a portfolio of property, you've given it to a letting agent, and they keep telling you that rents keep dropping. And the rents keep dropping. And you go, but I don't understand it. They go, there's massive oversupply. And then you realize that the agent is not VAT registered and doesn't want to be VAT registered, which means their turnover, I think the VAT threshold is 85,000. Their turnover will never exceed 85K, which means they will never want your rents to exceed whatever the level is.
Yeah, they're working against you. As soon as that is the case, you've got a ceiling, haven't you, from that perspective?
You have. We had a situation like that where it took a while for the penny to drop, and then we realised I don't understand why, and that's something completely off the wall. So that's again understanding the agent. Do they have skills, for example, to manage HMOs? Are they registered with all the right authorities that they need to be registered with, the ombudsman, etc. The other thing is contractors. You buy a property, I'm going to convert it into an HMO. Have you got the right contract, a JCT contract in place? Have you seen references? Why would you pay them money up front to do work? Do the work. They'll have credit terms with their with Jewsons or whoever might be supplying materials. But I often hear investors go, well, I just gave them 35 grand up front. And then you end up having a problem. We had a problem on a project we did. We were testing building a portfolio in the north, used someone who claimed to have fantastic credentials. They'd appeared in the press. They were linked with a property trainer. And the guy was a complete and utter charlatan. In the end, we had a dispute. The kitchen was put in the basement, which had been agreed, and the basement had not been tagged. In the end, we took a view. This is a side thing, actually. If you have a problem, my view, get rid of it. So a bit like Warren Buffett last Saturday announcing, we've sold our airline stock. I've taken a hit. So if it's eating up, don't be emotional, but if it's eating up brain power, just get rid of it. So that particular property, we built it. It was painful. We sold it. We moved on. Move on to the next deal. So that's working with contractors. And again, I mentioned earlier about having a really good go-to solicitor. And so you need a good broker, people who you work with. So in our business, for our bridging business, yes, I lend my own money and we broker. I've got a whole team that work with me on the broking side who have different skills. And I don't want to be reliant on one person. So always have a backup. Yeah.
Yeah,
So I
absolutely.
think those are the key things that we have learned. Yeah.
And that backup is having another exit strategy. And going back to, if you have a problem, get rid of it. I'm a firm believer. I have a saying that I kind of live by, but I never know where it came from. So I'm sure someone can tell me at some point. But if you lose money on roulette, you don't have to win it back on roulette. So just because you're playing that one game, you can start again. You can go play blackjack. You can go play something else. Cut the loss first, stop the bleeding, and go again. And a lot of people try and dig their way out of they go deeper and deeper into the hole. Really, they stick with the problem because they don't want to admit they were wrong, or they don't want to lose face sometimes. So I think that's an important lesson that you touched on there.
No, absolutely. I've got a couple of great books. This one here is just the Warren Buffett Making of an American Capitalist. Absolutely brilliant his story. And then there's another one which I've got behind me, which is the Warren Buffett, The Snowball. And I love reading about people like this. I think he's what, 89 years of age. It's a wealth of experience. So I'm a great believer in reading or listening to audible books just to learn what have other people done, so that you can learn from the mistakes that they've made. Definitely.
On that, actually, this is going to be one of my last questions. Is what you've just touched on with Warren Buffett. I'm a firm believer of their behaviours, their habits really shape who they are and their success, and really contribute to their success. So what are some of the behaviours or even daily habits that have worked for you in the past, and that you can share with us, that you think have helped contribute towards success?
Sure. Because when we said we'd do this podcast, I didn't want this to be a pitch about bridging, not at all, because money is money. But hopefully I've shared one or two sort of stories that people can learn from. But there were two things that I wanted to pick up on today. And funny enough, one was watching a movie last week with Al Pacino, and it's called Misconduct. And there's a piece in there where Al Pacino does this monologue on reputation. And I thought, I'm going to use that because it's absolutely key. So the first thing is reputation. And that is, as an investor, your reputation is key. How it defines you. So, for example, it's how your tenants will see you. How you act today in this tricky environment will define how people will want to do business with you in the future. And I'd say, go and look at some of the big businesses, see how they have behaved in this COVID environment. Those who've done a great job, those who haven't, because they will pay the price, and then we will have short memories. So reputation, I think, is key, and you need to understand that, and understand how can you help your clients. So if you've got tenants, what can you do to help them? So one of my guys, he's got a lot of commercial clients, so he's going through the whole process of, look, these are the things that you can apply for. These are the grants that you can apply for. Here's the bounce back loan. Are you eligible for that? The new self-employed financing piece, which I mentioned earlier as well. So that's how you go about helping people. But also the other thing is, what's the cost of a bad reputation? And I've always built my business on my reputation. I run this business with Charlotte. We don't want staff. I've run big businesses where I've had 50, 60 salespeople working for me when I built big sales teams in other businesses many years ago. And I don't want to have a big business. But people know, if they engage with us, they know that we're blunt and direct, and we just tell it as it is. And so I think that's really important, is understanding what is your reputation. And there are reputation strategies. Go Google it, do a bit of research, and think, okay, actually there's something we could do. The other thing I want to pick up on is standards. Now, I remember being it was December 2013. It was the PIN annual dinner. I was a guest there at the NEC in Birmingham. And the keynote speaker was a guy called Derek Mills. And I thought, never heard of Derek. He wrote a fantastic book called The 10-Second Philosophy, which is the one is there. You can just ask the Buffett, and it's the blue one. Yeah, called The 10-Second Philosophy. So let's cut to the chase. He talks about standards, not goals. And I remember driving back that night thinking, God, that's really hit me. Because a goal is simple in so much as we can write a list of the things that we'd like to achieve as a goal. So you're here and you're trying to attain something. So my question is, if you're listening to this, is how many goals have you written down and actually done nothing about? If you flip this the other way, go, okay, let's have some key standards. So my key standards are, I don't drink any booze midweek. I can't see my personal trainer now, but I have 3 personal trainer sessions a week: Monday, Wednesday, Friday, 11:30, which is why I do my one-to-one strategy review sessions on a Tuesday and a Thursday. And these in the normal world, these do not move. They're not goals, they're standards. And actually, as the word says, you actually stand by them. So it's a matter of having, so for example, no TV, say after 10 o'clock. So it's just simple things where you've got standards in your life whereby they're not even negotiable. It's what you do. So I have every day, I do use technology, but I went back to having a hardback journal. Every day I write down what's going to happen that day, the calls I'm going to make, the meetings. Right now, obviously Zoom calls, etc. Any home project stuff that has to be done, all of the tasks I'm trying to achieve. At the start of every week, we have a week review. Okay, so what has to be achieved this week? Working step by step. At the end of every quarter, what has to be achieved in the quarter? Go back over what we were meant to achieve, and then the same for the half year and the year. And so there are a whole bunch of standards that we've created, very different to a goal, because they cannot be moved. And that, I'd say, is probably the 2 things. What's your reputation? How can you work with your clients? So we've got an issue with a client right now on a loan that needs to be repaid. We're working our way through it so that, we've worked together for many years. How do we move that forward? And then how do you write yourself some standards so that you can actually, that's what I'll do. So if you're going to go and lose, I don't know, half a stone in weight or whatever it might be, or you're going to go and walk 3-4 miles a day, it's documented and it's done. So yeah, they're the 2 big things that I've picked up and like to share with people.
No, I appreciate that, Rory. I completely agree. I think it's Tony Robbins who says, you rise to your standards and you meet your musts at the end of the day. And that's exactly what a standard is. And I think, people set so many goals that they become arbitrary sometimes.
Yep.
It's I think they're great 2 lessons to share with us. Thank you for that.
No, definitely. Good stuff.
Rory, just lastly, what's the future for Close Bridging Finance? Where are you guys focusing moving forward from here?
Yeah, so this is unprecedented. It's very strange. So our focus right now is we've got, there's a couple of loans that we're working with clients that are due back. There's going to be a few delays. They're all being handled. I think the first thing is to get out of lockdown. Doing new lending right now is not that easy. So we're not actively looking today because we've got projects lined up at legals to go. And so I think we want to get a real feeling for what's going on in the market. We lend and we broker, so we'll always broker. That I think will get a bit easier for regular, if you're doing regular houses on buy-to-let mortgages, I think they'll work all day long. I've got a JV partner. We were about to go and buy a whole bunch of stuff, so separate to the bridging bit, but buy rundown 3-bed houses, fix them up and sell them. Now, I pulled the plug literally a week before lockdown and said, don't buy anything, because I don't think we'll even be able to get in and do the work. We probably wouldn't even get the conveyancing done, let alone flip it. So that's sort of ready to go. But it ain't going to be for a while. We'll just have to gauge what's going on. Once we get an understanding of what the phases of getting out of lockdown are, then obviously we'll start looking at doing some new loans and any potential joint venture stuff that we can do with partners for projects that make sense. I am cautious by nature, but I'm a money lender, which sounds strange. But you just have to get a real feel for, it's back to what is the market demand. You don't want to, you win your deals when you buy. So you've got to be buying at the right price. Linked to this, our number 1 metric is return on capital employed. So whether we had a portfolio of property or we were lending money or we were investing money, say through a SIP or an ISA, long-term, very long-term strategy there. I think there could be some great stocks that you could potentially buy. You've got to do your research, so not property related. But on joint ventures, if the return on cash is there, we would look at it. And then also, as you know, we do a fair number of one-to-one strategy reviews. I've not really done them via Zoom. That is a personal interaction. You come and spend 4 hours here, Charlotte bakes a wonderful cake, gives a nice lunch, and I want to get those back up and running again. And I prefer those to be face to face. And we've got a few of those which are scheduled too. But on the whole, I think it's been cautious, aware of what's going on in the market, look for opportunity. If the deal looks about right, we strike. We don't own any other businesses, but I was speaking with a friend of mine. We did a joint venture some time back, and he is actively speaking to insolvency practitioners where there are potentially some businesses that, for mainly through cash flow, they will probably go under. Maybe they can get some loans, maybe they can't, but I think there will be opportunities where some businesses are solid, that might be worth looking at. And also, I think there'll be some operators, depending on how old they are, they'll have family members who are not interested in their businesses, but they're rock solid businesses. And there may be an opportunity there as well to acquire different trading businesses that could be unrelated to property, which would be a good thing because you want to spread your risk. Yeah, that's what we're looking at.
No, I appreciate it. No, there's some interesting final thoughts as well. Rory, thank you very much for joining us today. It's been great catching up. I've thoroughly enjoyed it. Rory, for those who want to follow you, find you, learn more about you, where can they go?
Yeah, so the first one, Raj, really easy. The website is closedbridgingfinance.com. That's CLOSED, bridgingfinance.com. Email is simple, info@closedbridgingfinance.com. Or what I like is the old-fashioned telephone, 01962 885 927. So 01962 885 927. You can get me on Facebook, where it's a mix of business and personal. I do have an Instagram account as well, and I'm on Twitter. But actually, email and phone is probably the best way. And call me. I'll listen. I'll chat with everybody and anybody if I can help. Who knows what a conversation can lead to? Because how we built our business, and I know you have, it's all about networking. Just speak to everybody, find out what's going on, and who can you help, and what problems can you solve.
No, absolutely. I think that's how we met probably several years ago now. And look at us now, sat down here, locked in our houses, trying to save the world. So
absolutely, yeah. No, it's great. I've known you for a long time, Raj, and I wish you really well with your podcast series. It's a privilege to be able to share, what my thoughts are. As I say, I don't have all the answers, but certainly I like to have an opinion, and it's good to promote sort of dialogue and discussion. And you never know what's going to come out of that.